The roof estimate is $50,000. The money is sitting in the traditional IRA, so you call and ask them to send $50,000. Simple. Here is what most people do not price in. That withdrawal is not a withdrawal as far as the tax code is concerned. It is income. Ordinary income, added on top of everything else you already have this year. And on a household already collecting Social Security, that one transfer sets off 3 separate things, one after another, and only the first one shows up on the tax return you are expecting. Today we put a real household on the table and run all 3. Let me set up the couple, and I want to say clearly that these are illustration numbers. Yours will be different. The structure is what matters. Bill and Carol are both 67. They collect $48,000 a year in Social Security between them. They pull $30,000 a year out of the traditional IRA to cover the gap between their benefits and their spending. They are not taking required withdrawals yet. Before the roof, their taxable income is modest. The $30,000 from the IRA is ordinary income. Some of their Social Security is taxable, but not much, because their provisional income is only a little over the line. After the standard deduction for a married couple in 2026, which is $32,200, their taxable income lands well down inside the 12% bracket. Now the roof. They take out $50,000 in one call in December. Layer 1. The bracket. For a married couple in 2026, the 12% bracket ends at $100,800 of taxable income. Below that line you are paying 12% or less. Above it, every additional dollar is taxed at 22%. Their IRA withdrawal for the year just went from $30,000 to $80,000. That $50,000 stacks on top of everything else, and a large piece of it crosses the line. So part of that money is taxed at 12% and the rest at 22%. And the 22% piece is the one people never see coming because they think of themselves as being in the 12% bracket. They were. The withdrawal moved them. Layer 2, and this is the one almost nobody prices in. More of their Social Security becomes taxable. Here is the mechanism. Social Security is not automatically taxable. Whether it is depends on a figure called provisional income, which is roughly your other income plus half of your Social Security benefits. For a married couple, if provisional income is under $32,000, none of the benefit is taxable. Between $32,000 and $44,000, up to half of it can be. Above $44,000, up to 85% of the benefit can be pulled into the taxable column. Now notice something. Those two numbers, $32,000 and $44,000, are fixed in the statute. They have never been adjusted for inflation, not once. Which is why a rule that was originally written to touch a small number of higher income retirees now reaches most households with any withdrawals at all. Bill and Carol were already above the top threshold before the roof, but not by a wide margin, and not all of their benefit was being counted yet. Adding $50,000 of IRA income pushes their provisional income far past the line and drags a much larger share of that $48,000 of Social Security into taxable income. So they are paying tax on the withdrawal, and they are paying tax on Social Security benefits that would not have been taxed if they had not made the withdrawal. That is why the true cost of taking $50,000 out is not 50,000 times a tax rate. The withdrawal makes other money taxable too. Layer 3. Medicare 2 years later. Medicare charges a surcharge on top of the standard premium once income passes a threshold. In 2026, those thresholds are $109,000 for a single filer and $218,000 for a married couple. Bill and Carol are nowhere near $218,000, even with the roof, so in their case this layer does not fire. I want to be honest about that rather than pile on a scary number that does not apply to them. But here is when it does fire, and this is who needs to hear it. If your household income is already somewhere in the 150s or higher, a $50,000 withdrawal can carry you across a surcharge threshold, and the way Medicare works, the premium is set from the tax return filed 2 years earlier. So, a withdrawal in 2026 shows up in your 2028 premium. Nobody warns you in between. And if you are a single filer, the threshold is $109,000, which is a great deal easier to cross with one large withdrawal than people expect. So let us total it up for Bill and Carol. They asked for $50,000. Between the piece taxed at 12%, the piece taxed at 22%, and the extra Social Security benefits pulled into the taxable column, their federal tax bill for the year goes up by something in the neighborhood of $11,000 to $13,000, depending on exactly how the Social Security calculation lands. Round it. To put $50,000 on the roof, they had to move about $62,000 out of the account. That is the number, not 50, 62. Before we get to the fixes, I want to answer the objection I can hear from here, because it is a fair one. Somebody is thinking, fine, but the money in that IRA was always going to be taxed eventually. It is pre-tax money. Sooner or later I take it out and I pay. So what have I actually lost by paying now? Two things, and they are both real. The first is the rate. Money taken out inside the 12% bracket costs 12 cents on the dollar. Money taken out above that line costs 22. It is the same dollar from the same account doing the same job, and the difference is entirely about how much came out in one calendar year. So the loss is not that you paid tax. The loss is that you paid a higher rate than you had to. The second is the Social Security effect, and this one is a genuine one-time loss rather than a timing difference. The extra tax you pay because more of your benefit got pulled into the taxable column is not tax you were going to pay later on that IRA money anyway. It is an additional cost created by stacking, and it does not come back to you in some future year. So the honest framing is not that withdrawing is bad. It is that a lumpy withdrawal costs more than the same money taken smoothly, and how much more depends on where the lines fall for your household. There is a related version of this that catches people, so let me name it. Some households take a big withdrawal in the same year they do a Roth conversion because both feel like good housekeeping. Those two decisions compete for exactly the same room inside the 12% bracket. If you do both in 1 year, the second one is being taxed at 22%, whether you meant that or not. Now here are 3 ways to get the same roof for less, and the first one is the biggest. 1. Split it across 2 calendar years. Take $25,000 in December and $25,000 in January. Same roof, same contractor, same money. But now each year gets half the income stacked on it. And in Bill and Carol's case, both halves may stay inside the 12% bracket instead of half the money getting hit at 22. Contractors are generally fine with a deposit and a balance, especially across a month boundary. This one move is free. It is completely legal. It is nothing more than choosing dates, and on this example, it saves more than any other decision in this episode. The only thing to watch is that the calendar year is what matters, not the invoice date. The tax year is decided by when the money leaves the IRA. 2. Look at what else you have before you touch the traditional IRA. Money in a regular taxable brokerage account is often much cheaper to use because you only pay tax on the gain, not on the whole amount. Selling something with a modest gain to raise $50,000 can cost a small fraction of what a $50,000 IRA withdrawal costs. And if you have a Roth IRA that you have held long enough, qualified withdrawals come out with no tax at all and do not enter into the provisional income calculation, which means they do not drag your Social Security into the taxable column either. That is the quietest advantage a Roth has, and almost nobody lists it. I'm not telling you to raid the Roth. For a lot of households, the Roth is the last account they want to spend. But if the choice is between paying 22% plus extra tax on your Social Security or taking a qualified Roth withdrawal, that comparison deserves to be run rather than assumed. 3. Compare it against borrowing. I know, nobody at 67 wants a new loan. but run the arithmetic instead of running from it. If a home equity line of credit is available at a rate you can actually get, and you can repay it out of your normal cash flow over 2 or 3 years, the interest you pay may be less than the tax hit of pulling the whole amount out in 1 year. Especially if the interest also lets you keep your income low enough to avoid a Medicare surcharge. I am not saying borrow. I am saying that in every case I have run, people compare the loan to nothing at all, instead of comparing it to the fully loaded cost of the withdrawal. Compare it to $62,000, not to $50,000. One practical note on the mechanics of the withdrawal itself, because this trips people up every year. When you request money from an IRA, the custodian will ask how much federal tax to withhold. A lot of people leave the default in place without thinking about it, and then either get a surprise bill in April or effectively overpay and wait a year to get it back. Neither one is a disaster, but there is a third option worth knowing. If you are taking the money late in the year, having tax withheld directly from the IRA distribution is treated as though it was paid evenly across the whole year, which can prevent an underpayment penalty in a way that writing a check in January cannot. That is a genuinely useful quirk, and it is one of the few times the timing rules work in your favor. The other thing to decide before you call is which investments inside the account get sold to raise the cash. The tax on the withdrawal is the same either way, since it is all ordinary income coming out of a pre-tax account. But what you sell determines what is left in there, and if you sell whatever is easiest, you can quietly end up with a portfolio that no longer matches what you intended. Decide it deliberately, or ask whoever helps you to. A few things that change the arithmetic, so you know whether this episode is even about you. If you are under 59.5, there is an extra 10% early distribution penalty on top of everything I just described, with a narrow exception of up to $10,000 for a first-time home purchase. That changes the calculation completely and makes the split-year approach even more important. If you are already taking required minimum distributions, some of the income was coming out anyway, so the marginal cost of the extra withdrawal is what matters, not the whole amount. And if your income is low enough that none of your Social Security is currently taxable, Layer 2 may be the biggest number in this whole episode for you, because you are the household that has the most to lose by crossing that line for the first time. Let me put it in one sentence, because this is the sentence I want you to keep. A withdrawal from a traditional IRA does not just cost you the tax on the withdrawal. It can also change how much of your Social Security is taxed, and it can set your Medicare premium 2 years out. Price all three before you make the call, not after. The standard note: I am not your accountant or your financial advisor, and this is general education rather than advice about your situation. Bill and Carol are an illustration. The tax figures are rounded on purpose because the Social Security calculation runs on a multi-step formula, and the 2026 numbers used here come from published tables. Run your own case with someone who can see your whole return before you move anything. Now tell me something. Have you ever taken a large withdrawal for a house project or to help family, and did the tax bill come out where you expected? I would especially like to hear from anybody who split it across 2 years on purpose, because that is the move I wish more people knew about before December. If this was useful, subscribe. We run the numbers here every week, one decision at a time, with the arithmetic on screen. I am Susan. Multiply, then subtract. In that order.